Hopefully we've given you a nice picture of how we look at markets and how we compile portfolios. I'm just going to pop over to a few questions. Mike, for you, would financials, i.e. banks, be considered cyclical? Any reason not included in the previous slide?
Pete, yes, they are too, certainly when one thinks about it in a global context, yes, banks definitely sit, and I've seen it more and more in the way they're being classified recently, in that cyclical category. I perhaps never used to think about them like that, but I think what certainly the global financial crisis has made me realize, the way that regulators are now almost using the banks as a shock absorber every time we have a crisis. And I sort of wondered whether this is partly a consequence of a much more globally leveraged world. The thing that regulators learned in the global financial crisis is the first thing you do when we experience some financial stress is you go and stop the banks paying dividends. And I'm starting to see, we saw that again happen last year. And I'm starting to see, I'm thinking this is going to be a wash, rinse, repeat model. And I think that's going to increase the cyclicality in the way banks perform as investments. So absolutely, I would see that as the status quo going forward. Yes, and even prior to that, I would argue if you thought about how they typically operate through interest rate cycles, they would tend to be cyclical. But in short, I would say even more so today and going forward than they were in the past.
Yeah. Another question in the chat room, the view on REITs in South Africa, still too much downside risk. I think the property market is a little bit like the market as a whole. It is very specific companies with very different exposures and different outlooks. I think the average South African only property portfolio has got some recovery growth in it. As COVID comes down, more people return to shopping centres. And in fact, in the convenience sector, the convenience retail type sector, you've seen turnovers at higher levels in 2019. But once you've got to that recovery growth, the fact of the matter is that there's no ways that properties can sustain this kind of 6 to 7% escalation in an inflation environment of 4 to 5. And building costs haven't gone up for 5 or 6 years. So for the next few years, you're going to see every time a lease needs to get renewed, either there won't be a tenant, given the low economic growth, or there's going to be a 15 to 20% reversion. And we think that'll last for some time. So you've got 70% of your properties, the rentals going up at 7%, and 30% of them going down at 20%. And that kind of gives you close to a no growth scenario after taking into account the increase in cost base. So, that's the SA component, but within that, you've got some very interesting global counters. We really like Mass, and the CEO is a guy who basically founded and was resulted in the formation of Bepi Rockcastle, one of the smartest property guys we think in Central Eastern Europe. So that we think those look exciting. So in our SA equity portfolio, we've got Mass and Bepi Rockcastle. Mark, a question for you. The quality CEO is leaving South Africa with the talent to replace. What does it mean for the future?
Yeah, I mean, there have been a number of instances where that's happened. And it is a concern. I suppose that this is a great question, actually. I'm just thinking about that. There's a tendency, I suppose, to always want to focus on the horses we know. And, there's obviously a platform of people behind them that we don't know. And I suppose it's fear of the unknown that you doubt, the quality of the individuals. Yeah, but it's undoubtedly a theme that, has raised some concern. I think there were 3 kind of quite well-known CEOs that were announced recently that are heading out. I'm just thinking of the Click CEO as one that is heading on. My sense is one shouldn't overplay these things. It's never ideal to see this going on.
There's 100 material listed companies. We're talking about 3 people.
Exactly.
It's not a trend, but it is
absolutely. Absolutely.
I think also, if you look at it positively, it's what foreign investors have always seen in South Africa is a high quality of South African CEOs. The fact that they're able to go and get those global positions, and in fact, Rob Schutte at MTN is a case in point. So I can't recall where he's going, but he's going to.
He went to British Telecom. So
That's
he's
right.
now based in the UK, working for British Telecom. Absolutely.
Yeah, I think there's many South African CEOs that can and will run big global businesses. Certainly from my days as a broker, when you took foreign asset managers around South Africa, they certainly rated South African management as among the highest quality in emerging markets.
And just a thought that's occurred to me, I mean, if you look at SA Inc. broadly in terms of how companies managed their way through the COVID crisis, and what was quite a patchy policy in terms of lockdowns and what have you, and certainly not nearly the fiscal and monetary support that say US enjoyed. I would say South African companies in aggregate did a fantastic job of managing their way through the crisis, and certainly the consumer retail orientated companies in particular. I can almost not think of an exception of a company that didn't materially exceed analysts' expectations ultimately coming out of this crisis. So I think it does speak sort of volumes to the fact that we still have pretty good tier of management in most of these businesses.
There's a question centering around more the US and the US market and economy, I guess. Will the US go into recession? Is it all about to collapse? We think quite to the contrary. There's a huge amount of momentum in the US, and companies are experiencing fantastic growth and some fantastic cash flows. And the technology businesses behind them have got incredibly strong tailwinds. So we certainly don't see much chance of a US recession. I think the short-term issue at the moment is more around a temporary factor of logistics shortages and the growth being so strong that it's actually put a constraint on everything. And we saw Nike's results come out yesterday, where they talked about, and it's really started in China, where their growth has slowed simply because, and it's similar to the chip shortage story, where they can't create enough product for the supply. So we're not, we're not really in the camp where we think the US is about to fall in a heap. And it's about that logistics issue. And then, are interest rates forced to rise faster than what people are expecting? Because is the inflation transitory type argument? But, it's more around those issues than any kind of collapse in the US.
I think that there's a fair argument that you can make that, maybe earnings expectations. Pete put up the slide earlier on just showing how strong the expectations are currently around, the earnings in 2021 and 2022. And there's no doubt with the supply chain bottlenecks we're seeing, things that are almost beyond management's control. Is there a risk that we see pockets of earnings disappointment? Absolutely. I would be very surprised if earnings expectations haven't got a bit ahead of themselves and, reality catch up with us. But I think that's a long stretch away from a situation where we're talking recession and collapse. Certainly Pete dead right on the point that, technology and sector in particular has got some very powerful tailwinds. And
a lot of that's independent of economic growth.
Absolutely. And don't, in terms of secular trends, don't underestimate the deflationary forces that come through from, the advancement in technology. So, we certainly sit in the camp that, we're living through a fairly unpleasant period of intense inflation, but it is likely to be transitory. I mean, already, for example, you seem to be seeing commodity prices coming off, and very quickly that turns from an inflationary underpin to a deflationary force. So just a couple of thoughts there, not to become overly focused on some of those negatives.
Yeah, there's a question. We'll take two more questions, and I think we'll try and round it off. Dale can round it off in a few minutes' time. Will the resources sector recover from the recent slump, and how long before you get out of this cyclical? I think we're at a stage now. You had a rising tide, which benefited all resources. I think you're now getting to the stage where it becomes quite commodity specific, and I think there's very different outlooks for different commodities. Due to the energy crunch in the world, as we said, thermal coal prices have gone through the roof. So something like Thungela we really like. Iron ore's come off from $220 to $100. And the prices, I think the likes of the Anglos and Billitons never really priced in 220 at all. Otherwise, Anglos would have gone to 1,000. So you've seen them come off in the range of kind of 15, 20%, or maybe 25% of their highs. But iron ore really becomes about China as a driver. And I think the property development balance sheet woes in China is the key reason they've come down. Platinum has got its own very specific nuances. There's been a temporary fallback in demand for platinum due to chip shortages. And there the question is really one of how long that lasts. Then you've got, the kind of new world renewables type metals like copper and lithium and the like, which, we think, there'll obviously be cycles within it, but they've got great 5-year futures. So, and I think you've seen that reflected in our portfolio. We've got very out of benchmark type exposure to resources based on the kind of arguments that we're using.
Yeah, it's a great point you make there, Peter. One of the things we're facing as a bit of a challenge at the moment is I think that for a while, South Africa was quite lucky in that, the commodities that were performing, namely iron ore and the PGMs, were exactly the commodities to which our miners were most exposed. If we do talk about, maybe a move more towards green metals, copper and what have you, we're now looking at the likes of Glencore. It's probably a better way to play that. But, that has all sorts of ESG or more G issues that you have to make peace with. So, that certainly presents a much bigger challenge. Are you prepared to sort of hold your nose and live with those risks that, the regulators in the US dredge up some, act of disappointment that management committed in years gone past and in one of the countries it operates, because it represents really the only way to gain more pure exposure to, the metals that are now in favor. Unfortunately, Anglos and BHP very much more iron ore focused, which, has already fallen considerably. But, the immediate outlook, particularly with, as Pete mentioned, China looking to curb steel production related to property and its own environmental issues, is looking a little bit clouded, to be honest. The big question out there is the degree to which infrastructure spend in the US and Europe can offset what looks to be a bit of a headwind. So, me personally, I'm looking much harder at some of the other metals, and you'll see that within our portfolio, we are actually quite underweight the likes of Anglo and Billiton because of those concerns about iron ore for the time being. I think it's more the green metals, the copper, the lithiums, the PGMs that are going to rebound. And I personally have a question mark over, what's going to push iron ore back up, particularly as potentially we see supply issues out of Australia and Brazil potentially alleviating some of the supply constraints that have actually supported iron ore in the past.
And I think oil will come back. There's ultimately an endless supply of oil. It's the extent to which they turn the taps on and off. And something like Thungela, which is the thermal coal story, I've got absolutely no doubt that thermal coal will come back to $60 to $80 at least from the current 160 over the course of the next few years. But that's not priced in. It's kind of it's trading at 1 year's cash flows. So maybe just to round off from our side, a lot of general questions coming through. Let's to pick one on China. That's going through a slowdown at the moment. Quite a bit of it prompted by Chinese government actions where they've tightened emissions and trying to get climate under control. And then this Evergrande property development company where the balance sheet is a problem and they're not able to pay back their bonds, and that's raising a lot of concerns. So you are seeing China have a slowdown over the course, and you've seen that kick through into the resources companies that Mike's talking about, and iron ore in particular. My underlying feeling, and Mike can give his perspective, is that the Chinese government has managed to manage GDP growth through the cycles and is the best placed in terms of capability to stimulate of all the countries in the world, because the powers that be can make the decisions in a very short time period without the political ramifications. So it's essential for China to keep their population happy, to keep that GDP growth coming. Everybody's waiting for that kind of stimulus to come through. I think they're not in a massive hurry, but I've no doubt that they will come through. Chinese valuations, particularly the Chinese tech sector, the regulations that they've got, that market's crashed. So you've got this huge valuation anomaly in the world where US shares are close to their record high valuations, and Chinese shares are trading at less than 50% of those valuations. So certainly in our global portfolios, we're nibbling on the Chinese equation, although it does have its own idiosyncratic risks, and we limit our exposure from a diversification point of view. But the underlying momentum, retail consumer growth, increase in GDP per capita over time, I think China will remain the biggest engine of world growth for many years to come.
Right? Yeah. It's been a really frustrating year for us in terms of investing in China. And I guess if we could go back knowing what we know now, we might do things differently. But I would absolutely concur with the view that right now, it makes sense to hold the line. It feels to me like capitulating on China now would be akin to, selling global banks at the depths of the COVID crisis last year. And, then we've seen what's happened to the likes of JP Morgan rebounding to the extent it has. So, it does feel very oversold. I would say that I feel that going forward, China is going to require a lot more specialist investment expertise to do well. What I have learned through this crisis is that I think the importance of calling the right areas of China, as opposed to just sort of dumbly investing in the blue chips of that market, is going to become much more important, because, from 5-year cycle to 5-year cycle, it's very likely that government policy is going to have much bigger influence in the relative winners and losers. And that certainly is the big learning that I've taken out. I mean, do I think that one should be holding the line on China? Yes. But the route out of this is likely to be probably a different grouping of shares to what one might have traditionally owned in the past.
And then you get some fascinating situations. I think a good example is Alibaba, where the government regulation saying you couldn't have walled gardens where you couldn't let other people in, and to get rid of anti-competitive practices. So Alibaba had to open up. And then you've got the third biggest player in the e-commerce space, JD.com, which then is now allowed access to more suppliers and can be a bigger business. So in fact, through all of this, you've had Alibaba get tanked 35% off already quite a low level, but JD Group going up. So I think you've got to understand what's happening there and be in the right stuff. So Dale, I think that's our story. I'll leave it to you to close up.
Pete, Mike, thank you so much for your time. It's always wonderful to see that if we go over time, if you've got two such fabulous storytellers, that we've got 90% of people happy to go over time to listen to you. So thank you very much. I think the interplay between both of you was wonderful. Just two very quick ones from me before we sign off. CPDs will follow as we get them. That normally takes about 10 days. And we do have an Anchor YouTube channel. So you can go back and look at all the recordings that we've made. Look at anchorcapital.youtube, and the recording of this session will be sent out to all people that have attended. Thank you very, very much, and we hope to see you at the next Essential session. Bye-bye.